Today we are going to study central bank functions. What is central bank? It refers to an apex body that controls, regulates, directs the entire banking and monetary structure of the country. All financially developed countries have their own central bank. Central Bank of India is Reserve Bank of India. It was established on 1st April 1935. So let us discuss the functions of central bank: currency authority, banker to the government, banker's bank, and supervisor, custodian of cash reserves, lender of last resort, clearing house, custodian of foreign exchange reserve, control of money supply and credit. Central bank has the sole authority of issuing currency in the country. In India, RBI has the sole right of issuing paper currency notes except 1 rupee note and coins, which are issued by the Finance Ministry of India. Central bank keeps three main considerations regarding issue of notes, that is uniformity, elasticity and safety. Central bank is obliged to back the currency with the assets, gold coins, foreign securities, domestic governments, local currency securities of equal value to enhance the public confidence in paper currency. RBI tries to keep money growth within a target range and keeps inflationary pressure under control, and it strives to maintain at the lowest low level. Government is also authorized to borrow money from central bank. When government faces deficit in its budget, it borrows from central bank by selling its securities. When central bank acquires these securities, they issue new currency. This is known as monetizing the government debt or deficit financing. Now the next function is banker to the government. The Reserve Bank of India acts as a banker, agent and a financial advisor to the central bank and all the state government. As a banker, it carries out the following functions. It maintains a current account for keeping their cash balances. It accepts receipts and payments for the government and carries out exchange and other banking operations. It also gives loans and advances to the government for temporary periods. As an agent, the central bank also has the responsibility of managing the public debt. As a financial advisor, the central bank advises the government from time to time on economic, financial and monetary matters. Now the next is banker's bank and supervisor. The central bank acts as the banker to the banks in same way as commercial banks acts for general public. As the banker's bank, it performs the following functions. First of all, it accepts the deposits and advances loans to commercial banks. It also provides clearing house facility to the commercial bank. It is a check clearing facility provided at one center at all the banks. In its supervisory role, central bank regulates and controls commercial banks. The regulation of banks may be related to branch expansion, their licensing, etc. The control is exercised by periodic inspection of the banks and returns filed by them. Now the next function is custodian of cash reserves. Commercial banks are required to keep a certain proportion of their deposits, that is known as cash reserve ratio or CRR, with the central bank. In this way, central bank acts as a custodian of cash reserves of commercial banks. The next function is lender of last resort. When commercial banks fail to meet their financial requirements from other sources, they approach the central bank to give loans and advances as lender of the last resort. Central bank assists these banks through discounting of approved securities and bills of exchange. The next function is clearing house. As central bank holds the cash reserves of all the commercial banks, it becomes easier and more convenient for it to act as their clearinghouse. All commercial banks have their accounts with the central bank. Therefore, the central bank can easily settle claims of various commercial banks against each other by making debit and credit entries in their accounts. Next function is custodian of foreign exchange reserves. Central bank maintains foreign exchange reserve in order to promote international trade and also exercises managed floating to stabilize exchange rate for the domestic country by selling and purchasing of foreign exchange. Thank you. Today we are going to study control of money supply by the central bank. Control of money supply and credit. The Reserve Bank of India is empowered to regulate the money supply in the economy through its monetary policy. It is a policy adopted by the central bank of an economy in the direction of credit control or money supply. As RBI has the sole monopoly in currency issue, it can control credit and supply of money. The central bank adopts various measures to control the supply of money in the economy. Largely, these measures relate to credit supply by the commercial banks. To control the money supply or credit supply, RBI uses two types of instruments: quantitative instruments, qualitative instruments. So, we are going to discuss them in detail. Quantitative instruments of credit control. These instruments are used to influence the total volume of credit in an economy. Central bank tries to increase or decrease the amount of credit available in the economy. Supply of money is lowered to tackle inflation and it is raised to tackle deflation. Various quantitative instruments used by the central bank are as follows. First of all, we are going to discuss bank rate. Bank rate is the rate at which central bank of a country lends money to commercial banks to meet their long-term needs. RBI has been actively using bank rate to control credit. The bank rate is announced by the central bank at regular intervals in order to respond to the market conditions. An increase in the bank rate increases the cost of borrowing from central bank. It forces the commercial banks to increase their lending rates, which discourages the borrowers from taking loan, and hence the ability of commercial banks to create credit decreases, which helps in correcting the problem of inflation in the economy. Rise in the bank rate will lead to rise in market rate of interest, which further increases the cost of capital, and it leads to fall in demand for credit and fall in the supply of money, which ultimately helps in correcting the problem of inflation. On the other hand, when the bank rate decreases, the market rate of interest also decreases, which leads to decrease in the cost of capital, and hence the demand for credit increases and the supply of money also, which solves the problem of deflation. So now the next quantitative control is open market operations. It refers to the buying and selling of the government securities by the central bank from to the general public or commercial banks. RBI is authorized to sell or purchase treasury bills and government securities. Open market operations directly affects the supply of money in circulation and cash reserves held by the commercial banks. Sale of securities by central bank to commercial banks reduces their cash reserves, which adversely affects the bank ability to create credit and therefore decreases the money supply in the economy. Whereas purchase of securities by central bank increases the reserves and credits, creating power of commercial banks. The next is repo rate. Repo rate is the rate at which central bank of a country lends money to commercial banks to meet their short-term needs. The central bank advances loans against approved securities or eligible bills of exchange. An increase in the repo rate increases the cost of borrowings from the central bank. It forces the commercial banks to increase their lending rates, which discourages borrowers from taking loans. It reduces the ability of commercial banks to create credit. A decrease in the repo rate will have the opposite effect. When the commercial banks have surplus funds, so now this is very different from the repo rate, that is reverse repo rate. So, whenever the commercial banks have surplus funds, they can deposit the same with the central bank and earn interest. The rate of interest paid by the central bank on such deposits is called reverse repo rate. So it is the rate of interest at which central bank accepts deposits from the commercial banks. Reverse repo rate allows the commercial banks to generate interest income. When reverse repo rate is raised, it encourages the commercial banks to deposit their funds with the central bank. This has the negative effect on the lending capability of the commercial banks. Lowering reserves repo rate has the opposite effect, which raises demand for borrowings from the commercial bank. Now the next is legal reserve requirements, that is called LRR. According to this policy of the central bank, every commercial bank is obliged to maintain reserves out of the total deposits received from the depositors. It is a fast-track method to control credit creating power of commercial banks. Commercial banks are obliged to maintain two types of reserves. First is cash reserve ratio. It refers to the minimum percentage of a bank's total deposits required to be kept with the RBI. Change in CRR affects the ability of commercial banks to create credit. That is, when there is increase in CRR, it reduces the reserves of commercial banks and credit creating power of commercial banks and vice versa. Statutory liquidity ratio. Every bank is required to maintain a fixed percentage of its assets in the form of liquid assets called SLR. The liquid assets include cash, gold and other securities. SLR is maintained in the form to show the liquid assets, power of banks to meet its daily requirements of cash withdrawal. Increase in SLR reduces the ability of banks to give credit and vice versa. So you can see in the chart that LRR compromises CRR and SLR. So CRR means deposited in the RBI. And what is SLR? That is kept with the commercial banks. Now we are going to discuss qualitative instruments of credit control. These instruments are used to regulate the direction of the credit. Various instruments used by the central banks are, the first one is margin requirement. It refers to the difference between market value of security offered for loan and the amount of loan given against that security. So let us understand it by an example. Amount of the building given as a security for a loan for 1 lakh rupees and loan given against this security is 80,000. So what is the margin requirement? 20,000. So RBI may prescribe different margins for different sets of borrowers against the security of same commodity. An increase in the margin discourages the borrowers from taking loan and hence the money supply decreases. Whereas fall in the margin encourages the people to borrow more. Now the next is moral suasion. This is a combination of persuasion and pressure that central bank applies on other banks in order to get them act according to the policy of central bank. It is like rendering an advice to the commercial banks by the RBI to follow its directives. The banks are advised to restrict loan during inflation and liberal in lending during deflation. So model suasion can be used for both quantitative as well as qualitative credit control. The next is rationing of credit, that is also called selective credit control. Under this, RBI give directions to other banks to give or not to give credit for certain purposes to particular sectors. This means that this method can be applied in both positive and negative manner. In positive manner, it means using measures to channelize credit to priority sectors. The priority sector includes small scale industry, agriculture, education, exports, etc. In negative manner, it means using measures to restrict flow to credit to particular sectors. Thank you. Today we are going to learn money multiplier process by commercial banks. As we have learned that currency with the public and demand deposits with banks are components of money supply. Currency creation, high powered money, is done by the central bank of a country, and the demand deposits are created, that is called bank money, by the commercial banks. Let us understand how the commercial banks create money. The capacity of the commercial banks to create credit depends on two factors: amount of initial fresh deposit, that is called primary deposit. The deposits of households and the firms held by the bank are called primary deposits. LRR, that is called legal reserve ratio. It is the fraction of deposits of commercial banks which is legally compulsory for the commercial banks to keep in the form of cash, that is called CRR, and liquid assets, that is SLR, as reserves. LRR determines the limit to create credit by the commercial banks. Banks need to hold a fraction of deposits as reserves in order to enable them to meet the demand for withdrawals from the depositors. The credit or deposits created by commercial banks are called derivative deposits. A bank cannot lend more than primary deposits. Total money creation formula is initial deposit into 1 upon LRR. Now let us understand this. Money creation or deposit creation of the commercial bank with one of the numerical example. Let us illustrate the process of credit creation by an example. Let us suppose that every bank has to keep a cash reserve of 20% against its total deposits, and its primary deposit is rupees 1000. The bank will keep 20% of rupees 1000, that is to meet any demands arising out of its liabilities to its depositors, and lend the remaining amount of rupees 800. Borrowers will use this money and the money will come to the banking system, as borrowers would most probably pay in the form of checks drawn on bank. Now, this rupees 800 will be derivative deposit. Bank will keep 20% of rupees 800 in reserve and lend out remaining rupees 640 to borrowers. This 640 rupees will next be called as derivative deposit, and the bank will keep again 20% of this 640 in reserve and lend out remaining, that is rupees 512 to borrowers. So as you can see in the table, this table indicates that in the first round 1000 rupees are deposited. This is called primary deposit. And the second, the bank is going to keep 20%, that is 200 rupees. Now the money that has to be given for loan is 800. This round is called first round. In the second round, again this 800 will be called as the primary deposit. Again 20%, that is 160, will be reserved by the bank and 640 will be given for the loan. Then third round, 640 will be the primary deposit. Again 20%, that is 128, and 512 will be given for loan. And in the fourth round, 512, that is the primary deposit. Again the legal reserves 20%, 102.4, and the loan amount is 409.6, and so on, 409.6, 81.92, 32.327.68. So you must be amazing that how much this process will go. This is infinite till the total sum of legal reserves is equal to 1000 rupees. It will continue. So let us see how do we calculate it. That is, total money creation is equal to primary deposit into 1 upon LRR, and our primary deposit is 1000 rupees into 1 upon 20%, and if you calculate you will find 5000. So this is called money creation process, which is very clear as in the above table. Thank you. Today we are going to study foreign exchange rate. This chapter defines the meaning of foreign exchange and related terms, how foreign exchange rate is determined, study of foreign exchange rate regimes, that is fixed and flexible rate, and their differences. Thereafter, hybrid system of exchange rate and operation of foreign exchange market. Foreign exchange rate refers to all currencies of the rest of the world other than domestic currency of the country. For example, in India, US dollar is the foreign exchange. The rate at which one currency is exchanged for another is called foreign exchange rate. In other words, the foreign exchange rate is the price of one currency stated in terms of another currency. For example, if 1 US dollar exchanges for 60 Indian rupees, then the rate of exchange is 1 US dollar is equal to rupees 60, or 1 rupees is equal to 1 upon 60, that is 0.0116 US dollar. So I have taken only one example. So the exchange rate keeps on changing. So every day we have to look to newspapers and internet to check its new exchange rates. Foreign exchange market is the market where national currencies are converted, exchanged or traded for one another. Now let us see the functions of the foreign exchange market. First function is transfer function. Transfer function refers to transferring of purchasing power among countries. Second function is credit function. It implies provision of credit in terms of foreign exchange for the export and import of goods and services across different countries of the world. Third is hedging function. Hedging function pertains to protection against foreign exchange risks, where hedging is an activity which is designed to minimize the risk of loss. Now let us study sources of demand of foreign exchange. The demand or the outflow of foreign exchange comes from the people who need it to make payments in foreign currencies. It is demanded by the domestic residents for the following reasons. First is import of goods and services. When India imports goods and services, foreign exchange is demanded to make payment for imports of goods and services. Second, tourism. Foreign exchange is demanded to meet the expenditure incurred in foreign tours. Third, unilateral transfers sent abroad. Foreign exchange is required for making unilateral transfers like sending gifts to other countries. Next is purchase of assets in foreign countries. It is demanded to make payments for purchase of assets like land, shares, bonds, etc. in foreign countries. Repayment of loans to foreigners. As and when we have to pay interest and repay the loans to foreign lenders, we require foreign exchange. Next is speculation. Demand for foreign exchange arises when people want to make gains from appreciation of currency. Now, what are the reasons for rise in demand for foreign currency? The demand for foreign currency rises in the following situations. When price of a foreign currency falls, imports from that foreign country becomes cheaper. So, imports increase and hence the demand for foreign currency rises. For example, if the price of $1 falls from rupees 60 to rupees 55, then imports from the USA will increase as American goods will become relatively cheaper. It will raise the demand for US dollar. Second situation is when a foreign currency becomes cheaper in terms of the domestic currency. It promotes tourism to that country. As a result, demand for foreign currency rises. When price of a foreign currency falls, its demand rises as more and more people want to make gains from speculative activities. So as you can see in the diagram, demand curve of foreign exchange slopes downward due to inverse relationship between demand for foreign exchange and foreign exchange rate. In the figure, demand for foreign exchange, that is US dollar, and the rate of foreign exchange are shown on the horizontal axis and vertical axis respectively. The demand curve US dollar is downward sloping. It means that less foreign exchange is demanded as the foreign exchange rate increase. This is due to the fact that rise in the price of the foreign exchange increases the rupee cost of foreign goods, which makes them more expensive. As a result, imports decline. Thus, the demand for foreign exchange also decreases. Now, the supply, that is inflow of foreign exchange, comes from the people who receive it due to the following reasons. First is exports of goods and services. Supply of foreign exchange comes through exports of goods and services. Tourism, the amount which foreigners spend in the home country increases the supply of foreign exchange. Remittances, that is called unilateral transfers from abroad. Supply of foreign exchange increases in the form of gifts and other remittances from abroad. For example, your relatives must be living in foreign country and they may send gifts to you. Loan from the rest of the world. It refers to the borrowing from abroad. A loan from US means that flow of US dollars from US to India, which will increase supply of foreign exchange. Foreign investment. The amount which foreigners invest in our home country increases the supply of foreign exchange. Speculation. Supply of foreign exchange comes from those who want to speculate on the value of foreign exchange. The supply of foreign currency rises in the following situations. When price of a foreign currency rises, domestic goods becomes relatively cheaper. It induces the foreign country to increase their imports from the domestic country. As a result, supply of the foreign currency rises. For example, if price of $1 rises from rupees 60 to 65, then the exports to USA will increase as Indian goods will become relatively cheaper. It will raise the supply of US dollars. When price of a foreign currency rises, foreign direct investment from rest of the world increases, which will increase the supply for foreign exchange. When price of a foreign currency rises, supply of foreign currency also rises as people want to make more gains from this speculative activities. Now, as you can see in the diagram, supply curve of the foreign exchange slopes upward due to the positive relationship between supply for foreign exchange and foreign exchange rate, which means that supply of foreign exchange increases as the exchange rate increases. This makes home country's goods become cheaper to foreigners since rupee is depreciating in value, and the demand for our exports should therefore increase as the exchange rate increases. The increased demand for our exports will translate into greater supply of foreign exchange. Thus, the supply of foreign exchange increases as the exchange rate increases.
Now we will study determination of foreign exchange rate.
Exchange rate in a free exchange market is determined at a point where demand for foreign exchange is equal to the supply of foreign exchange. Let us assume that there are two countries, India and USA, and the exchange rate of their currencies, that is rupee and dollar, is to be determined. Presently, there is floating or flexible exchange rate in both the countries. Therefore, the value of currency of each country in terms of the other currency depends upon the demand for and supply of their currencies. In the above diagram, as you can see, the price on the vertical axis is stated in the terms of domestic currency, that is how many rupees for 1 US dollar, and the horizontal axis measures the quantity demanded or supplied. As you can see in the diagram, the demand curve is downward sloping. This means that less foreign exchange is demanded as exchange rate increases. This is due to the fact that rise in the price of foreign exchange increases the rupee cost of foreign goods, which makes them more expensive. As a result, imports decline. Thus, the demand for foreign exchange also decreases. Now you can see in the diagram, the supply curve is upward sloping, which means that supply of foreign exchange increases as exchange rate increases. This makes home country's goods become cheaper to the foreigners since rupee is depreciating in its value. The demand for our exports should therefore increase as the exchange rate increases. The increased demand for our exports translates into greater supply of foreign exchange, and thus the supply of foreign exchange increases as the exchange rate increases. Now further, you will see change in demand, and the diagram is there. You can see increase in demand for dollar and increase in the demand for US dollar in India will cause the demand curve to shift to D1 as dollars as shown in the diagram, and the exchange rate rises to P1 as dollars. Note that increase in the exchange rate means that more rupees are required to buy 1 US dollar. When this occurs, Indian rupee is said to be depreciating. Now change in supply, as you can see in the diagram. Increase in supply for dollar and increase in the supply of US dollar causes the supply curve to shift from S1 to S1 dollar, and exchange rate falls to P1 as dollars. In this case, rupee cost of US dollar is decreasing and the Indian rupee is said to be appreciating. Now decrease in demand for dollar, as you can see in the diagram. A decrease in the demand for US dollar in India will cause the demand curve to shift to D1 as dollars and the exchange rate falls to P1 as dollars. Note that decrease in the exchange rate means that less rupees are required to buy 1 US dollar. When this occurs, Indian rupee is said to be appreciating. Now, as you can see in the diagram, decrease in the supply of dollar. A decrease in the supply of US dollar causes the supply curve to shift to the left and exchange rate rises to P1 as dollars. In this case, rupee cost of US dollar is increasing and the Indian rupee is said to be depreciating. In this session, we are going to study different types of foreign exchange rate systems. First is fixed exchange rate system. This system is also called pegged exchange rate system. The system of exchange rate in which exchange rate is officially declared and fixed by the government is called fixed exchange rate system. When domestic currency is tied to the value of the foreign currency, it is known as pegging. To maintain stability in fixed exchange rate system, government buy foreign currency, and when exchange rate appreciates and sell foreign currency when exchange rate depreciate. This process is called pegging operation. That is, all efforts must be made by the central bank to keep the rate of exchange stable. Fixed exchange rate is not determined by the forces of demand and supply in the market. Such a rate of exchange has been associated with the gold standard system during 1880 to 1914. According to this system, the value of every currency is determined in terms of gold. Accordingly, ratio between gold value of the two countries was fixed as exchange rate between these countries, of whom the currency exchange takes place. For example, value of $1 is equal to 100 grams of gold and value of a rupee is equal to 5 gram of gold. So what will be the value? $1 is equal to 100 upon 5, that is rupees 20. Now the next term is devaluation of currency. Devaluation refers to decrease in the value of domestic currency in terms of the foreign currency by the government. It is a part of fixed exchange rate. Just opposite is the revaluation of currency, which refers to increase in the value of domestic currency by the central government. It is a part of fixed exchange rate. Now, the second type of exchange rate is called flexible exchange rate, or it is also called floating exchange rate system. The system of exchange rate in which value of a currency is allowed to float freely as determined by demand for and supply of foreign exchange is called flexible exchange rate system. So already we have studied the diagram in the previous topics. Under this system, the central bank without intervention allow the exchange rate to adjust to equate the supply and demand for foreign currency. The foreign exchange market is busy at all times by changes in the exchange rates. So sometimes there is currency appreciation, sometimes there is a currency depreciation. So when there is a currency depreciation, it refers to decrease in the value of domestic currency in terms of foreign currency. It makes the domestic currency less valuable and more of it is required to buy a foreign currency. It is a part of flexible exchange rate. For example, rupee is said to be depreciating. If price of $1 rises from 60 and the rupee's price rises from 60 to 65, then what happens? Effect of depreciation of domestic currency on exports. That means there will be fall in the price of domestic currency, say rupee, in terms of the foreign currency, say dollars. It means with the same amount of dollars, more goods can be purchased from India, that is, exports to USA will increase as they will become relatively cheaper. And what happens in currency appreciation? Currency appreciation refers to increase in the value of domestic currency in terms of foreign currency. The domestic currency becomes more valuable and less of it is required to buy a foreign currency. It is again a part of flexible exchange rate system. For example, Indian rupee appreciates when price of $1 falls and rupees from rupees 60 to rupees 55. What will be its effect on our domestic currency? It will have its effect on our imports. Appreciation of domestic currency means a rise in the price of domestic currency, say rupee, in terms of the foreign currency, say dollars. Now 1 rupee can be exchanged from dollars, that is, with the same amount of money, more goods can be purchased from USA. So it leads to increase in imports from the USA as American goods will become relatively cheaper. Now the next system, that is called managed floating rate system. Managed floating exchange rate is a mixture of a flexible exchange rate, the float part, and the fixed exchange rate, the managed part. In other words, it refers to a system in which foreign exchange is determined by free market forces of demand and supply, which can be influenced by the intervention of the central bank in foreign exchange market. Under this system, there is also one system that is called dirty floating. Central banks intervene to buy or sell foreign currencies in an attempt to stabilize exchange rate movements in case of extreme appreciation or depreciation. Now the next type of exchange rate system is wider band system. It is a system that allows wider adjustments in the fixed exchange rate system. It allows adjustment up to 10% around the parity between any two currencies in the international money market. For example, if 1 US dollar is fixed as equal to 50 Indian rupees, 10% revision upward or downward is to be allowed in this exchange rate of 1:50. Exchange rate may be revised as 1:60 plus 10% equal to 1:66, or as 1:60 minus 10%, that is 1:54. Now the next type of system is called crawling peg system. It allows small but regular adjustments in the exchange rate for different countries which have different currencies. Not more than 1% adjustment is allowed at a time. Indeed, it is a small adjustment, but it can crawl, that is, it can be repeated at a regular intervals. So these are the terms. Further you can revise, that is devaluation, revaluation, currency depreciation and currency appreciation. Thank you.